In this presentation, we're going to briefly introduce a strategy for church and community development using techniques that have been used mainly for commercial property, but also historically in countries as varied as England and Fiji. The strategy works basically on ground rent. This is how it goes. The parish owns a block of land. It doesn't have the resources to build anything, but it does own the land, and it has the intention of building a parish church. The first step is to find an investor or a group of investors who are prepared to build dwellings on part of the church property. Once they're built, they'll be occupied by tenants who will pay a property rent to the investors. Now, for the purposes of providing social housing, the rent may be set at a discount to market. This is part of the details that we can work out as we go along. Now, the investor's purpose is to use the property rent to both pay for their investment in the dwellings, return a reasonable rate of profit, and pay ground rent to the parish because the investors are leasing the land from the parish. Preferably, I'm recommending over a 30-year term. 30 years is worked out on the basis of the life expectancy, if you like, of an interest in property, practically speaking. A family moving into one of these properties, maybe with babies or just starting their family, 30 years later, they're probably going to find themselves largely as empty nesters. And so a 30-year period has a nice practical side to it, and there are a number of other benefits that we can look at in detail separately. Okay, at this stage, the parish has their land, it has a group of properties on it, a group of dwellings on it, and they're earning ground rent. They still don't have their church. However, they do have a regular cash flow, being the ground rent off their dwellings. The parish can then approach a bank for a loan to build the church, and the parish then assigns the ground rent, or uses the ground rent, formally or informally, to act as debt servicing payments, basically to pay off the loan for the church. If this process operates, say, over 30 years, which is a common term for a building or a property loan, it means that over the period of time when the investors are earning their return on their building investment, the parish is paying off its church. After that, the parish still continues to earn the ground rent. That's basically the strategy. Looks fairly complicated. It involves a couple of leases. Let's go through the various players now briefly. First of all, the investors build and operate the dwellings. They supply the funds for construction. They hold a 30-year head lease on the land, which means that then they're able to sublease individual parts of that land, the dwellings, to individual tenants. They collect the full property rent, and I'm recommending for a period of 30 years. The property rent is set below market for social housing objectives. The investors are leasing the land from the parish, and so they pay a ground rent to the parish. How is the ground rent calculated? The ground rent is calculated as the difference, or the gap, the residue, between the property rent, which is worked out from the market, perhaps adjusted for the purposes of social housing objectives, less the investor's revenue. The investor's revenue can be calculated by straightforward financial calculations that ensure that the repayment of the principal that the investors have put into the project in their construction, plus a rate of profit, will amortise over the investor's lease of 30 years. That's a relatively straightforward financial calculation. The investor's rate of profit I would recommend will probably be in the vicinity of about 7 to 9% per annum. That will be subject to market and probably final or further investigation. To give you an idea, in 2017, the residential housing investment market returned a little over 8.1% and was the strongest investment return of any area of the investment world. And so whether they were shares or property trusts or what have you, residential housing investments, the little resi investments, actually turned in the highest investment rate of return at I think it was 8.1%. And so I'm suggesting that a return of somewhere between 7 and 9% is quite reasonable. The investor's interest, I would recommend that it be set up using a non-listed property trust, because that protects the investors a little better and also provides a degree of liquidity, and so it provides a transferable interest over the 30 years period of this investment project. The last point to make about the investor's position here is that this function could be replaced by the parish using government social housing sponsorship. That's really a separate project or a separate strategy, but if you like, you can conceptualise it by simply putting government loan funds for social housing instead of the investors. It does mean that the parish would probably need to set up a separate entity to manage that, but that expertise and that structure can be designed in such a way that it is a functioning semi-independent business. We looked at the tenants now, recommending that first of all the tenants will occupy the dwellings on a 30 plus 30 year lease. 30 plus 30 means that the lease runs for 30 years plus an option for the tenants who are able to choose an additional 30-year lease as part of their original contract. The first 30 years, the tenants will be paying a full property rent to the investors, again adjusted for social housing objectives as necessary. We can conceptualise this as a period over which the tenant is virtually paying for the construction of the land, the house, not the house and land, simply the house. This makes it a similar interest, if you like, to what happens in the ACT, where people owning houses in the ACT actually only own the improvements. The land itself belongs to the government and they pay an annual rent to it. And this is basically producing a similar strategy for private church land. I'm recommending a second 30-year option, and that would be a lease to the parish only and at ground rent only. What this means is that after the tenants have paid close to a social market rent for that 30 years, and if you like have virtually paid off the interest in the construction, at least they've paid sufficient so that the investors have a good return and then they basically retire out of the project. The tenants then have a further 30-year option where all they pay is the ground rent. Again, there's a parallel with the ACT, where even after you buy your house and you pay back the money to the bank for the money that you may have borrowed from it, you still pay a perennial ground rent to the government. I'm recommending a total of about a 60-year interest, and the reason for that is that it needs to be terminating. That leaves a 30-year period which could be assignable. The tenants, we could structure the lease so that they could actually pass it on to other people, their friends or a completely independent person. And that provides the tenant with a durable terminating property interest, which is kind of a reward for paying the near market rent for the first 30 years. From the tenant's point of view, it means that the only variable is the property market risk. The reference here to finance risk is that if the tenant was buying the property outright with a normal freehold arrangement, they would go to the bank and they'd be subject to the variabilities of the finance market, so basically interest rate fluctuations. Here, there's no interest involved, so there's no finance risk, only what's going to happen to the property market, and even that can be managed, or the result of a strategy by the parish itself. Again, there are further details to go into later. Overall, from the tenant's point of view, they will be seeing affordable housing because the initial rent should be set sufficiently below market to achieve social housing objectives. In addition, because the parish isn't selling the land and therefore alienating its entire interest, the parish has the opportunity to include in the leases that it writes, which are always ground leases, what I'm calling social clauses. Now, these are covenants that limit the use of the land, and the dimensions for those are something which we can consider, or the parish might like to consider later on. The advantages is that it can help to provide basically a special purpose community, similar but not with the gates of a gated community. It can be given a particular name, and it becomes something that resembles a retirement village, only not for retirees but for young homeowners, young families, or whoever else the parish wants to put in there. But in the same way that if you move into a retirement village, there are a number of restrictions and expectations. I'm suggesting that by writing that into the ground leases, the parish will be able to exercise a certain amount of design of the community that ends up on their property, which I think would be very desirable for the purposes of the parish. When we move and look to the bank, the bank is really taking a fairly conventional position. The bank would be able to take a mortgage over the land. Now, the land now is really the land under the church and the land under the buildings. Because the land has never been alienated to the investors don't have a property interest in the land. They have a 30-year lease over it. And so the parish could mortgage the land under the dwellings to the bank. And there are aspects to risk that we can look at specifically to examine why that is a useful strategy. The bank is given ground rent as debt servicing payments for the loan to build the church. Now, you'll notice that the recommended, or the likely yields on the land itself, about 3 to 4% most probably, will be very close to the interest rate that would be likely to be charged on a mortgage for the purposes of some sort of construction. And so largely the ground rent should come fairly close to covering the debt servicing costs. And the bank also sees the security in the value of the dwellings if the whole thing falls over. Again, we need to look carefully at the various dimensions of risk. Moving to the parish offers a 30-year lease to investors, or finds social housing funds sufficient to build the dwellings. Either strategy will work, but will work on the 30-year lease. The parish uses the ground rent cash flow to service debt to construct the church, and it provides a second 30-year lease to tenants. Now, really, that second 30-year lease costs the parish nothing, because by this time the investors have earned a reasonable rate of profit and they have had their principal investment repaid. But it provides a perennial income to the parish, and that provides the capacity for longer-term parish building and also the life cycle costing to maintain the church, maintain the dwelling assets and other things. The advantage of this is that, unlike selling the land, where the parish will lose for all times, any cash flow from the land that they currently own, this strategy provides this perennial, basically perpetual cash flow. It may not completely cover the needs of the parish for building projects for paying for the church in the first instance, but over the longer term, it will provide this life cycle costing basically a perpetual income. The Church of England, by the way, does this on a large scale, both in England and in Australia. The parish also retains the long-term control of the land, so in the long term, because even at worst in 60 years' time, if they want to completely change their land use, they can do that. Again, by comparison with the sale option, once the land is sold, they'll never be able to get it back, except by buying it at what could then be the market value, which could be quite high. The last attribute from the point of view of the parish is that it provides social housing to families and a social dividend to the tenants during their second 30-year term. This is something which, if we were to look closely at the long-term prospects for an owner, we would find quite attractive in this strategy. We'll just look briefly at the risks to finish off. The investors basically take the construction, property market and rental risks. They're most of the risks in the project. They're earning a rate of return which is commensurate with those risks. There are reasons why those risks wouldn't be as great as in other develop and operate projects, and that's largely because the structure is overall designed as a social housing project, which means that its rents are going to be at a discount to market, and therefore the vacancy risk will be lower. Recommend that the investors' vehicle, the financial arrangements that the investors operate in, is set up so that it provides some level of liquidity, preferably through a trust structure. The bank holds a mortgage over land, so they will be seeing very low risk. So that should be attractive for getting a reasonable rate of interest from the bank when it comes to building the church. The parish enjoys a long-term control over the property with a perpetual income stream. This means that since rental income is below market, there should be a low rental risk, therefore a low ground rent risk. The parish also has the advantage of having the reversionary interest in whatever is built. So unless their houses are completely ruined in some way, even at the end of 60 years, they will end up with more than the vacant land than they started with. The last aspect is that because the parish is able to create a special purpose community through what I'm calling the social clauses, that should have the capacity of providing a desirable community for people to move into, again reducing rental risk, and also attract the kind of tenants, kind of occupants that are more likely to maintain the property and the whole character of the community in a way which is desirable. Overall, I would suggest that the risks here are manageable and the returns that are given to the various parties are quite equitable for their participation. And the overall long-term advantage, of course, is greater financial security for the parish, as well as providing a social outcome for the community.